Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. Let's get to some of the stories we're following for you now in the BNN Bloomberg newsroom. Montreal-based AtkinsRéalis is collaborating with Nvidia to integrate Nvidia's technologies into the development of nuclear-powered AI factories. AtkinsRéalis says the technologies could help provide a framework to design digital versions of the infrastructure before building it in the real world. Adding, AtkinsRéalis brings engineering expertise and experience in the nuclear industry to the collaboration. The Canadian Real Estate Association says home sales continued moving at a slow pace in February, but activity did start to pick up near the end of the month. The benchmark price of a home fell 0.6% from last month, and home sales were about 8% lower. However, a senior economist at the association says it expects pent-up demand from first-time buyers to translate into sales in 2026. Shares of Nvidia are plummeting today. The AI infrastructure company is aiming to raise $3.75 billion US through a convertible loan offering. The Dutch company says it intends to use the funds to finance business growth by building data centers and buying chips. Earlier this month, Nvidia struck an AI computing deal with Meta and secured a $2 billion US investment from Nvidia. Looking at the markets right now, they are holding on, staying in the green for St. Patrick's Day. Right now, the TSX up by about 0.45% south of the border. It's a similar situation. They're holding on. They were up more than 1% at one point, but now back down. You can see the S&P 500 up by 0.34, the Dow by 0.27, and the NASDAQ by 0.41. All right, global markets are facing renewed volatility as rising oil prices and geopolitical tensions add pressure to inflation and growth expectations. Joining us now to break down today's market trends is Tyler Ellegard, president of Gradient Investments. Tyler, thanks very much for joining us.
Thanks for having me.
Is oil and the Strait of Hormuz, is that the big thing right now? Is there anything else that can challenge it?
Well, if you want to consider the AI sell-off and the concern about the impact that AI is going to have on white-collar workers, but those two things combined, I would say those are probably the main two that we're focusing on.
And today we've seen oil going up. We're seeing the markets going up. Are people trying to get a sense? Are they trying to normalize what the situation is right now? What are your thoughts on that?
Yeah, it's a challenge because there really is no normalizing the situation, especially when you consider the geopolitical tensions and the conflicts that are going on overseas. But from a economic impact perspective, trying to normalize and understand what that actual impact is going to be on the future of prices and how that's going to affect consumers at the end of the day. And so trying to understand the longer this goes on, the conflict itself goes on, and the longer that oil is elevated, how is that going to flow through the economy? Not just the U.S. economy, the global economy, whether you're Canada, Mexico, Europe, how that truly impacts the global economy. And then from that perspective, how does that impact corporate earnings? And what does that look like the longer this oil or conflict stays on, or how elevated oil is over the coming weeks and months?
I mean, we're already seeing effects of the gas pump prices are soaring right now. What is long term? Like when do we start looking at this as possibly pushing? We've heard global recession. Is that a possibility? And at what point does it become a real legitimate concern?
Yeah, look, if oil is elevated for a week or 2 weeks, I don't think there's going to be much impact on the products that consumers are buying, because again, oil really goes into everything at this point. Talk about lipsticks and plastics and anything that you really touch on a daily basis. Any of the products that you're buying likely has some component of oil in it. So the longer this oil stays elevated, that's where you start to see the impact. So if we're talking a few weeks to a month, I don't know that it's going to have a major impact on the economy. Yes, you see it at the pump. It is a tax anywhere you go. You want to go do anything, you want to buy anything, you have to drive or take some type of transportation to get there. there, which will impact those prices. But that's more of a short term. So if we start to see oil elevated and companies have to start passing through cost to consumers, that's where you start to see it. So if we're talking more of like a 3 to 6 months, that's where you might start to see some impact. I wouldn't call it global recession because of that, but it could add fuel to that fire of concern on consumers.
And you mentioned AI. I imagine that's a longer term concern with layoffs. We're starting to hear about the layoffs, aren't we?
We certainly are. And the actual income cohort group that it's impacting, right? We're not hearing about the blue collar workers that are necessarily being impacted and laid off. It's more of the white collar jobs that that do a lot of this economic spending that are seeing the impact of AI and how it's overtaking their job or reducing the amount of workload that they have. So that is becoming a longer term concern, and how companies incorporate AI and the true impact, economic impact that's going to have on spending.
And with that, we're hearing about mega cap market broadening. Is that happening, and where are you seeing it?
Yeah, we are seeing it. And one area that we really like is large cap value. The other aspect of it, in our fund of funds portfolio that we run, we just added small and mid cap stocks as well as international. So we are seeing the broadening out, not just the technology and consumer discretionary names that we've seen for the last 2.5 years.
All right, and some of the stocks you're liking right now. First one, Amazon.
Yeah. So again, I just said we like SMID and international, but Amazon fits into that consumer discretionary camp. But the reason we like it, it's been an underperformer. Earnings are continuing to grow. AWS growth is back above 20%, and now the stock itself is relatively cheap comparative to its historical valuation. So we like this name from a longer term perspective.
All right. Next up, Broadcom, kind of tying in similar.
Yes, similar story, but Broadcom itself, if you think about, there was a Citrini research report that came out talking about AI and world in 2028. And I asked the question of, based on reading that, is who are those winners? Somebody's going to have to win. Obviously, there will be companies that lose, but Broadcom is well placed in the AI space to provide the chips that we need, the specialty chips that we need to continue advancing AI forward.
And the last one I want to touch on, Netflix. I mean, they really didn't lose, did they? Not getting. I mean, they could have won more maybe, but they are not losing either necessarily by not getting Warner.
Yeah, look, it's unfortunate because from Netflix point of view, having the Warner Bros. Content would have been great for their platform, but the price that they would have had to have paid is quite significant. And so I think, yes, they don't have it; it's going to someone else. But at the end of the day, investors can focus really on the fundamentals of Netflix again, rather than worrying about this overhang of regulatory oversight, getting the deal through, and then what does that do for their earnings going forward. So I think going back to the basics for Netflix and truly what the company is about right now. And
they've said they have some money to spend now, don't they?
They certainly do.
And where do you see that going, and how do you see that benefiting them with the money they have from not buying?
Yeah, you know what they could do is they could start buying different content packages from other companies. Now you might have to overpay a little bit for that, or you put that money back into creating your own content, which is what historically Netflix has done and has done a great job at doing. So I think you could start to see more content creation coming from Netflix again, or continuing that momentum.
Kind of, I want to say getting back to their roots, but that would be DVDs showing up at our front door. But getting back to their last set of roots that they had.
Yes.
All
exactly.
Right. Tyler, thanks very much for joining us. We appreciate it.
Thanks for having me.
Tyler Allegard, president of Gradient Investments. Well, Nvidia recently set a lofty revenue goal of $1 trillion. We'll have more on that after the break. Data from Stats Canada showing alcohol sales are slowing. And St. Patrick's Day will have to stand the test as restaurants look to broaden their options, their abilities here to bring in more customers as people drink less. For more, we were joined earlier by Kelly Higginson, president of Restaurants Canada.
the decline over the last 4 years. And what I would say with that is that it's happening at the same time as we've seen a dramatic increase in our input costs over the last 5 years. So we've continually see a drop. At this point, we've got 21.1% of total revenues in 2013 were related to alcohol sales, but that number has dropped down to 17.1 in 2023, which is the latest available data. So that's a pretty considerable drop in the last, 3 to 4 years. I think, we're seeing it per person at table service restaurants, a decline from $1,100 per person in 2019 to about $1,000 in 2025 when adjusted for population growth and inflation.
Kelly, you've given us the percentage of alcohol, but in terms of, can you just narrow it down to sort of a per revenue, like a per customer amount? And then also, if you would, what's the next highest margin item on a typical restaurant? Because I know alcohol is the highest margin, but what's the next sort of step and what can they promote?
So this is where we've got the challenges of the spending at table service restaurants. It declined from $1,170 per person in 2019 to $1,050 in 2025. So that is a pretty significant drop. And as to your point, what we've also seen is our, highest cost part is really in food costs and our margins in food costs. So, when we look at the increase in the cost of food over the last number of years, and that's really challenging our operators, the categories in order to find profit has become less and less available to our operators.
And this drop, is it solely by price because of cost? People just don't have the money to spend on that, or is it also they're just not drinking as much? And is it across the board, like from a smaller restaurant up to the high-end restaurants?
So it's a real mix. To your point, we've got 74% of Gen X who are stating that they're reducing alcohol for health and wellness concerns. But 44% of Generation Z are reducing alcohol because they are trying to save money. And the millennials right there in the middle with 51% are reducing alcohol for social and lifestyle cost reasons. So, we've definitely got a mix of all the reasons there. But, the reality is we've got a younger portion of Canadians aged 18 to 22 reported not drinking any alcoholic beverages in the past 7 days, which is a real switch compared to 54% for Canadians overall. So that next generation of consumers are drinking considerably less.
Wow.
Kelly, do you think there's any chance of stabilization here? I always get the situation that maybe the parts, and you mentioned it, is cyclical, but in terms of sort of getting down to a level where restaurants can actually sort of say, okay, that's the bottom, is there any chance of that?
I think we're actually, and look, I mean, this is all a guess, but to your point, I think we often see the pendulum swing in directions as far as trends. And, obviously we do have a chronic affordability issue, which that doesn't seem to be going away. But as far as kind of the lifestyle trends, we tend to see those pendulums swing pretty rapidly. And I do see it maybe starting to come back a little bit. But I also think as we talk to operators that we have to meet the consumer where they're at. So let's look at different ways that we might be able to. Is it serving lower alcohol level drinks? So some people are talking about still enjoying cocktails, but they're doing it maybe once a week. They're doing it less often, and they'll spend a little bit more for something that's higher quality but lower alcohol levels. Can we look at more operators? There was a period where we were increasing our ounces and glasses of wine up to 8 and 9 ounces for the large size. Maybe we need to look at having more serving those 3 and 4 ounces, something to sip on while you're having your actual meal. Those are going to be areas that we're going to have to explore. And I think there's definitely a lot of room for operators to explore the non-alcoholic beverage category. There's a lot of different ways we can have exciting cocktails that have no alcohol in them, but there's also some great products coming out on the market, beer, wine, and lower alcohol and no alcohol spirits.
And I think that may be challenging with the price too, because I've gone to restaurants and they have those mocktails. I know they don't call them mocktails anymore, but I mean, some of them are almost the same price or not much lower than a drink with alcohol in it. And I think you look and go, well, that's a lot of money to spend just for something that doesn't have alcohol in it. I just want to go back to, I mentioned about, is it across the board when it comes to restaurants, high end, low end? Is there a bit of a K-shape with the restaurants like we're seeing in the economy, where the higher end people are still spending on alcohol and higher end alcohol, whereas when you get down to the lower end, they're holding back?
Yes, I mean, where we've seen the biggest drop really is in the category of bars and nightclubs. They've seen the biggest drop over the last number of years. And again, this goes to when you're talking about the higher end. Definitely, we're still seeing the purchases, but we're seeing it. They're spending more on a higher quality of a bottle of wine as opposed to the volume of wine. So this goes to really consumers looking for that experience, and they'll spend a little bit extra to have a really good cocktail as opposed to having maybe 3 mediocre cocktails. And then again, with the wine and other specialty items. All
right, and we're out of time. I just want to ask one more question. It's St. Patrick's Day. What are we expecting for today?
You know what? I'm cautiously optimistic, but I think, if I think back to the days of the lineup starting outside of some of our favorite Irish pubs early in the morning for people to get a seat, I think it's fair to say that those days have come and gone. So, hopefully we see people get out and enjoy their local restaurants, because it's definitely a challenging period for all of us.
And that was Kelly Higginson, president of Restaurants Canada. Up next, we'll get to that story on Nvidia as they recently set a lofty revenue goal. Back in a moment. During the annual Nvidia GPU Technology Conference, company CEO Jensen Huang forecast that AI chip sales would reach $1 trillion by 2027, raising expectations from a previous outlook of $500 billion through 2026. Joining us to break down these numbers and that forecast is Noah Hammond, founder and CEO of Advisor Shares. Noah, thanks very much for joining us.
Thanks for having me.
There we go. Okay, we were worried we're connecting with you. That $1 trillion, is it kind of a real $1 trillion? What's changed from the $500 billion?
It's a big jump. My guess would be they have insight to the orders that are coming in and the clients that they're working with, and they certainly wouldn't throw out a number like that unless they felt like it was a realistic target for them.
Is it, I mean, how much bigger is it than the 500? Is it spread over a longer time, or is it essentially doubling it?
It seems like it's doubling it, but it does seem like that's a targeted number through the end of 2027. So, taking them a couple of more years to get to that number. So a lot can happen between now and then, of course, but they have been aggressively expanding into a variety of different areas, data centers, working on solutions for agentic AI. So they've got a lot of opportunities to hit that number over that time frame.
Are any worries that maybe they're spread too thin, or do you feel they have the capacity to handle all those new areas?
It's a good question. They're certainly maybe getting into some businesses where they're competing, maybe even with clients, right? Relative to things like data servers, they still got to keep an eye on AMD, who is, probably the only closest competitor, but again, not even close relative to Nvidia's market share. But don't forget, AMD is starting to get deals with, companies such as Microsoft. So as they start to compete with them and Nvidia starts to expand its offerings and looking, towards things like space data centers, keeping their eye on the ball relative to the chip sector, understanding that competition's coming. And so I don't know that it's going to be one of those things where they'll not hit those targets. I think it's a function of what valuation investors are going to put on a company.
And not worried about maybe stepping on some toes? You mentioned that they may be moving into some customers' areas.
Yeah, absolutely. Within data centers for things like Amazon and certainly Microsoft, who are in those businesses and also client of theirs. So yeah, there's a lot of overlap there. And so to your point, keeping the eye on the ball, focusing on their growth is important, but they also want to grow like any other company. And so offering complementary services, things that are targeting robotics and autonomous car driving will be fantastic opportunities for them, and probably great solutions for companies, smaller companies that want to be in that business or haven't invested in those areas like a Tesla has or a Waymo has.
Now, will the Blackwell and Vera Rubin chips, the new ones, are they the driver for this? Is this what they're resting on?
Yeah, I think so. I mean, that's their core, business relative to what drives the bulk of their sales. But, they've gone a lot in terms of M&A. Their most recent acquisition of Grok is going to expand their capabilities. So beyond just that core chip sector. So yeah, that's certainly their core competency. But again, growing with services and other what I'd call specialty chips or specialty solutions around that is going to continue to help these guys grow significantly.
All right. And you mentioned about the autonomous transportation. What kind of opportunities do you see with that partnership with Uber?
So that one's probably their biggest challenge, and maybe an opportunity where they can learn for a company, like Tesla, who's obviously one of their biggest, if not the biggest client that they have. And that's certainly a tougher space. I mean, we've seen how challenging it's been for Tesla itself to get to full self-driving. It's one of those things where I think the time frame Elon Musk probably put out there was, 2 or 3 or 5 years ago that they would be ready for it. But it's harder than it seems. You can get maybe 80% of the way there very quickly, but that last 20% and that last 10% and that last 5% takes a significant amount of time, effort, money, and data. So I don't expect that they're going to compete to the level that Tesla's at. But if you're a car company looking for a solution and wanting to compete in that space, you could probably find a real head start with the solution that Nvidia is putting together, hopefully. I mean, there's a lot of work ahead of them for that in that area.
All right. And then just going back to the GTC conference, that $1 trillion kind of was what stood out for everybody. What else, though, went on there? What caught your eye?
So probably the big push into, agentic, the robotics they mentioned, they talked about it. They did throw out the space data centers, which again will be an interesting thing for them to get to. They'll need to partner with people to get to space, of course. So I think all those things, it's very optimistic. It's interesting that it's coming, in a time frame where, investors have been valuing the stock a little bit less, right? This company is traded at levels of 50 or 55 of a PE, but then as low, recently in the 30s and 35s. And so, coming off their all-time high, which was around $210 or so, probably four-ish months ago, they're down from that. But I don't think it's a function of their lack of growth as the announcements were made. It's a function of what valuation investors are going to put and what other opportunities are coming ahead for investors with announcements like SpaceX or ChatGPT coming to the market as well. It's going to be a crowded space for tech investor dollars.
And when it comes to space, where do you see Nvidia partnering? What possibilities are there?
I mean, of course, I would think it would have to be with their biggest client or one of their biggest clients of Tesla, but they're even starting to see some competition, right, with Blue Origin. Now, they're still far behind what SpaceX capabilities are, but I would expect, there would be a nice opportunity for those companies to work more closely together relative to the chip needs that Tesla continues to have and the growth opportunities that Nvidia wants to take advantage of.
Okay, Noah, thanks very much for joining us. We appreciate it.
Thank you for having me.
Cheers. Noah Hammond is founder and CEO of Advisor Shares. Well, Canadian home prices dropped in February. We'll get into the details after the break.
Lured by lies of fast cash.
What did you think was in the bag?
Trapping young Canadians.
She's a 19-year-old girl.
As unsuspecting drug mules.
People pay a lot of money for cocaine.
W5 goes deep inside Hong Kong.
There are 4 Canadians in prison right now.
To uncover a crime syndicate.
She wants us to expose these people.
Hunting for traffickers.
They just asked me to find people for them.
Here at home, W5's Avery Haynes investigates. Saturday at 7 on CTV and Crave.
Foreign Affairs Minister Anita Anand is calling for a no weaponization of the Strait of Hormuz. Additionally, when asked about Trump's calls for assistance in the Strait, she said a request has not been made to NATO for the type of assistance being requested. Talking to reporters on a call back during her trip to Turkey, Anand also said she is working with other countries on the issue.
There should be no weaponization of international shipping lanes and prevention from countries around the world having the resources that they need. In fact, blocking the Strait of Hormuz violates the UN Convention on the Law of the Sea, UNCLOS, as well as customary international law, and ships from all countries have the right to pass through. This is a very important point that I'm working with countries from the Gulf region and around the world.
Nvidia CEO Jensen Huang is predicting the company's AI processors will help generate $1 trillion US in sales through 2027. Huang was speaking at Nvidia's biggest annual event, where he also unveiled a variety of new products. Huang announced plans to push deeper into central processing units. He also introduced new semiconductors and Nvidia's plan to develop chips for data centers in outer space. Canadian mortgage billionaire Stephen Smith is buying a minority stake in the Economist Group. Smith and his family's holding company, Smith Financial, will buy the entire 26.9% stake from private investment company Rothschild. The price of the transaction has not been disclosed. The deal is Smith's first foray into media. And taking a look at the markets right now, the TSX in the green again today. Perfect for St. Patrick's Day. It's up by 0.34%. And south of the border, it is a similar situation in the U.S. markets. Everybody in the green. S&P 500, 0.37. Dow by 0.31. And the NASDAQ by 0.45. All right, let's see what is trending today. Some of the TSX leaders, we'll take a look here. Go Easy, which has been pummeled this past week because of that earnings report, is up about 8%. One short seller praising the come clean moment for Go Easy. We'll see how the rest of the year if it goes easy for Go Easy. Another one to look at, BMO is expanding into California, adding banks down there. And people are reacting to that. They seem to be liking it, up by 0.65%. Scholastica also having a good day, up by about 4.4 right now, announcing a collaboration with AMD, and that has investors happy. Now, there are some laggards. CN Rail, it is down about 3.6%. Of course, it had that derailment in northwest BC. Another one taking a hit today, Alimentation Couche-Tard. It's off, it's bouncing back a little. It's off by 0.78%. It could benefit from oil earnings. We'll see. And that's their earnings, from oil. Their earnings come out tomorrow before the bell. Some other notable movers. Decent Music. It is up by, 20. I had to do a double take on that. It's up by, down by 24%. My glasses are a little dirty. I need to clean them. Down on their earnings. Now, MasterCard is up slightly, announcing it's acquiring a bank. Lemonade, Morgan Stanley upgrades Morgan Stanley. Sorry, I jumped there. MasterCard up on that bank acquisition, and Lemonade up 16%. Morgan Stanley upgrading for that one, and it's the first mover advantage, and it's up 16%. So good day for Lemonade. And let's bring in Annie Bergeron-Oliver. We're talking about Canadian home prices dropping in February, all that economic uncertainty. And Annie, buyers are sitting on the sideline, but are they ready for more? CTV's Annie Bergeron-Oliver joining us. Do we know what's driving the drop?
Hi, Roger. What's actually very interesting is that a little bit of this drop, specifically in the Windsor to Toronto area, was related to weather. The Canadian Real Estate Association says that housing sales were lower at the end of January, beginning of February, and they believe that's because that area around Toronto had some really bad storms at the end of January. And they think that's why housing sales were slower, because a lot of prospective buyers weren't able to actually get out of their houses, didn't want to leave their homes because the snow and the cold cold was so bad. So that's specifically to kind of that southwestern Ontario area. They say in some cases between January and February that housing sales actually dropped 25 to 35%. So they think that was actually strange and unusual. And so they're tying that to the weather. But overall, the Canadian Real Estate Association today is really painting this picture, Roger, of a sluggish housing market. Overall, if you look from between January and February, nationwide sales are down 1.3%, new listings down 3.9%, and now the benchmark price for a home is down 4.8% to $661,000. So back to your question about why, well, other than that southwestern Ontario portion where they do attribute part of the change to the weather, they're really saying a lot of this just has to do with hesitancy from buyers, that perhaps it's because people don't want to get into the market just yet. Some first-time home buyers may be concerned that, the bottom hasn't been hit yet, the prices haven't stabilized. They're concerned about losing money. But also economists are saying that there are a lot of people who are concerned with the Canadian economy right now, with the fact that there's higher unemployment, that job numbers recently have been weak, that there was also the tariff war going on, and now there's this war in Iran. And all of that changes consumers' confidence about the state of the economy, also about the housing market. And in some cases, if you look at oil, for example, going up right now, economists are saying that's going to impact inflation. And that also means that consumers may have less savings, less disposable income to be able to put towards a home, Roger.
Okay, Annie, thank you for that update.
Thank you, Roger.
Annie Bergeron-Oliver from CTV News. When we come back, we'll continue to break down the latest in Canadian housing data. That's after the break. The Canadian Real Estate Association says home sales slowed in February, with the benchmark price of a home falling 0.6% from last month and home sales down 8%. Let's get more from Sean Cathcart, senior economist at CREA. And Sean, thanks very much for joining us. Another rough month, same situation. What's driving it right now?
Sure. Well, obviously there's a lot going on out there. The one aberrant one that's been, I mentioned it last month and got a little bit of a hard time from some. So I can explain a little bit better, was that big snowstorm in Ontario. We track daily data. You can see it was January 25th, a Sunday. You got dumped with 2 feet of snow, and then the market went quiet for 2 weeks. The good news there on that particular one is it looks like the listings and the buyers are coming back in a big way in the second half of February. So I expect that one's resolved, ancient history, and we're going to see some improvement in Ontario in March. But more broadly, part of our forecast for this year has been a wind down in some of those hotter markets, the prairies, Quebec, and the East Coast, that have benefited so much from population growth that was just off the charts that they no longer have. Mm-hmm. That headwind is already at play. But the flip side of that, which is supposed to be the return of first-time buyers, which is a huge cohort out there that say they want to buy homes at some point, haven't really shown up on the scene yet. It's only February or March. So we do expect that at some point. Interest rates obviously aren't the greatest compared to the last 15 years, but it's probably as good as they're going to get. And actually, with the price of oil through the roof, you got bond markets now thinking that the Bank of Canada might have to make a hike this year, and that could play into higher mortgage rates like any day now, which could pull some people into the market sooner, but could hurt our forecast a little bit later on.
So in other words, it sounds like a complicated mess right now. There's a bunch of different things pulling in every different direction.
Yeah, exactly. It's meant to be a handoff from one market with a lot, BC and Ontario ice cold, all these other markets surprisingly hot, into one that's where things are a little bit more moderate everywhere. But you've got this return of these, this 25 to 40-year-old cohort is the biggest demographic cohort in the history of Canada. Younger baby boomers are a distant second at this point. These guys have it's census data, so we won't know for sure until next year. But I would guess 25 to 40 has got a homeownership rate now in the 40s, mm-hmm. like in the high 40% range. 15 years ago it was over 60%. So it's falling off a cliff. But we went out in the field with a huge survey at the end of last year, heavily indexing on that group, and 80% of them say they still want to be homeowners. So we know that cohort's out there. It's one of those things that's hard to see until they show up on the scene. With rates the way they are and a lot of uncertainty, I think that that's not going to explode onto the scene and blow the doors off, but certainly that's forms the basis of what demand we really think is going to come back this year. And further out, we'll see. I think move-up buyers might still be a little bit hesitant with rates where they are. But first-time buyers don't have a choice if they want to get into the market. And so the other question then is, do we have the kind of product that they're looking for? Many of them are into their mid to late 30s at this point. They don't want a one-bedroom condo, but a lot of the detached stock has become so expensive. It might still be a starter house, but if it sits on a $500,000 lot, it's not a starter property. And so that's where that missing middle conversation comes in as we look to double our home construction over the next decade.
And that is a challenge. Let's talk a little bit about some of the different sectors. Condos, you mentioned that maybe they're not looking for that. Does that and they've been taking a hit, or does that mean an even further hit for them, do you think?
I think the condo space is going to remain weak. Toronto's one story in that they've built a lot, and they built a lot of very small ones that people don't particularly want to live in now that the investors have left the picture. That's the Toronto story. Everywhere else in Canada, it's a different story. They haven't overbuilt condos as much, but they're massively building purpose-built rental apartments in the last decade in a way that they haven't since the 1970s. And that really is competition in the condo space. So that's sort of most cities in Canada, and then Toronto's doing its own thing. But in both cases, there's an oversupply of apartments and a lot of 30-somethings that are looking for something bigger than that.
All right. So, I mean, there's talk that people are going to move this year, feels like it. Is it going to be one of those where you hear one or two stories and all of a sudden the floodgates open and everybody starts looking? Or are you going to see a gradual kind of dipping their toes into the markets?
That's a good question. Steven Pinker has a new book out called When Everybody Knows That Everybody Knows. And I wonder to what extent, a lot of these young households are looking to others just like them, there's a ton of them, to see when people are going to move and whether that could create sort of a self-reinforcing thing of, okay, well, now's the time because everyone's jumping into the market. We'll just have to wait and see. It's certainly not happening just yet.
And I mean, talking about the new homeowners, what about those who are in a house already and are looking at either downsize, upsize? They're all waiting. What is their concern?
Well, for the downsizers, there's a lot of actually empty nester downsizers who feel that they are overhoused. I mean, there are many that don't, but for those that do, what they tell you is, we'd love to downsize and free up some of this, equity for our retirement, but there's nothing designed for that for me in my community. So one of the biggest ones is we need options like that. I think big apartments are a great option in existing neighborhoods. There would be a great entry point for young families, but also for downsizing, seniors. As far as move-up buyers go, I still, I shouldn't put myself as a representative agent in the model. You're not supposed to do that. But I look at a 4% interest rate. If I had to take on $250,000 to get an extra bedroom, I don't know that I'd be all that inclined to do that at 4% when I've been used to 2 and 3% for the last 15 years. But maybe some others feel differently. And then the interest rate story is another big question mark that's just come in the last couple of weeks, where bond markets seem to think that the Bank of Canada might have to hike later, but in the fullness of time, how much global sort of weakness is going to come out of this if oil prices stay high. So that's just a big question mark at this point.
All right, Sean, we're running out of time, but thanks very much for joining us as always.
Sure thing, Roger.
Sean Cathcart is senior economist at the Canadian Real Estate Association. Still ahead, today's Market Movers with Bloomberg's Matthew Griffin. Canada's inflation rate cooled more than expected this month, dropping to 1.8%. But economists expect this month's report is likely the dip before the spike. CTV's Annie Bergeron-Oliver has more.
Since the war in Iran began in late February, the price of oil per barrel has skyrocketed, increasing between 40 and 50%. And economists say that could push inflation up as early as next month.
Certainly the war as it is right now is going to impact on inflation. So the inflation numbers are going to go up. Once the gas prices go up, that goes directly into inflation. There's no way around it.
In February, annual inflation dropped to 1.8%, but the war had barely started when the data was collected. One gasoline-dependent sector economists say could start to rise: food inflation.
If you look at fresh fruits and vegetables that are coming in by truck from the southern U.S. or from Central America, that transportation cost is roughly 10% of the retail price. And so we will see some upward pressure for those products in the month of March.
Fresh figs. That possibility is concerning to many small business owners like Hanan Alame, who owns a charcuterie business. Alame loves the creative process, but says she's worried since the cost of food and gas seems to just keep going up.
It's been extremely hard. Even like I opened up a year ago, from a year till now, things have skyrocketed. It's been double in price. So even like the meats, the cheeses, the fruits, even gas, because I do deliver as well.
So what is the Bank of Canada, whose object is to keep inflation at 2%, likely to do when it makes its next rate decision?
I think the Bank of Canada is going to, without any hesitation here, stand until they know more about how this is going to play on inflation.
And that was CTV's Annie Bergeron-Oliver. Well, for some movers south of the border, we're joined now by Bloomberg Equities reporter Matthew Griffin. Matthew, thanks as always for joining us.
Roger, thanks for having me on.
All right, Eli Lilly losing some weight right now.
Yes, Lilly down about 6%. The stock was cut to a sell equivalent rating at HSBC. It's actually the only bearish rating on the stock right now. It's pretty rare for analysts to be negative on this name. And the analysts at HSBC are confronting head on the narrative that makes everyone so bullish about Lilly, which is weight loss drugs. That is a huge and booming market. It's the reason that the stock has tripled in the last 4 years. It recently briefly became the first ever trillion-dollar healthcare company. But what HSBC says is expectations may be too high there. The stock is priced for perfection. They point out that drug makers are competing on price in the weight loss drug market right now. Something I would point to is Novo Nordisk. They are cutting their prices for their diabetes and weight loss drugs in the U.S. by up to 50% as they compete for market share. So what HSBC says is the expectations for the size of the market looking at next decade might be too high. And in the near term, the expectations for therapies like the weight loss pill that Lilly is seeking approval of in the U.S. might be too high.
We talked to Rajesh Kumar about it. And one of the things he said, too, is that they're going to the pill and people don't necessarily stick to it as well as they do the injection because it's a daily and you have to be regular about it. And so he worries that people may just get away from it because they might see disappointment in it. Interesting concept with that.
Yeah, that's something that HSBC talks about is that the sort of consistency of people taking the pill may not be where the company wants it to be. And even if you look at the shots, the idea of whether people keep taking them and whether they regain all of the weight, as a lot of people tend to do after they stop taking them, those questions have been key in thinking about the health effects and the value proposition of these drugs.
All right, moving on to airlines. They're flying again.
Yes, well, Roger, you and I have talked about these stocks so many times over the last few weeks because they've really been front and center for investors during the war in Iran. And we're getting a bit of good news today, which is airlines are seeing very strong bookings. You had Delta and American give pretty strong revenue growth outlooks for the current quarter ahead of their appearances at the JP Morgan Industrials Conference. Now, there is a bit of irony there, which is why are the bookings so strong? Because passengers are rushing to buy tickets ahead of any price increases that happen due to the war in Iran and the increase in the cost of jet fuel. But of course, investors have known about the problem that the higher jet fuel prices pose for airlines, and now maybe they're getting a bit more color on the things that cushion that blow a little bit. But, I would say Delta up about 7% today, American about 3.5%. But Delta, I like to go back to the close on February 26th because these stocks started sliding even when people were worried about the war. Delta's still down about 7.5%, American about 22% since then.
All right, Delta just announced a deal with Nvidia. And quick, we're almost out of time, but can we sneak in? Oh, we are out of time. Matt, we got to go. We wanted to get about Uber's deal with Nvidia and Lyft's, but we're out of time. Sir, have yourself a great day.
You as well, Roger. Thanks.
Bloomberg's Matthew Griffin. Okay, that wraps up this edition of Trading Day as they were yelling in my ear. Have yourself a great day, everyone.